Welcome, you're watching the Mutual Fund Show. I'm Tamanna Inamdar. Now, this is your one-stop destination for all things to do with your mutual fund investments. And what we're talking about today is, I'm sure, a question that has definitely crossed your mind. Now, remember, when it comes to mutual funds, the conversation is usually about when to invest, how much to invest, and the advice that you'll hear possibly will be one that says, don't look at stopping your SIPs. But there could be times when you do need to, in fact, stop your SIPs or your systematic investment plan. So that is what we're going to talk about today. When do you stop your SIPs? We know when to start them, which is any time. But when should you rethink on your SIPs, pause them? Is it because you've reached your financial goals? Should you look at how the markets are valued or have run up at that point? Or maybe the fund that you put your money in is just not performing as expected. So we'll talk more about that today, and I'm joined by Anant Ladha, founder Invest Aaj for Kal, and Kshitiz Mahajan, managing partner and CEO at Complete Circle Wealth Solutions. Welcome to both of you, and thank you so much for joining us today on the Mutual Fund Show. Anant, let me start with you. I thought this was an interesting question to take up because, you know, the conversation is always about starting your SIPs, but there could be a time when you need to stop your SIPs as well. Obviously, you won't continue an investment into perpetuity. When is that point?
Hi, firstly, thank you so much for having me on the show. Always pleasure talking to you. I personally feel there are three incidences where you need to stop your SIPs. Firstly, if something has structurally changed in your fund, for example, fund manager has changed, or your fund has underperformed for a long period of time. For example, it has underperformed for 5 years, and and you feel that you have a better option. There has been change in the fund manager or in the style of management. Then is the best time to stop your SIP. Second, when you think that you have reached to your goals. For example, you did SIP for your home. You have reached to your goals, you have reached to your corpus. Now it is time to stop your SIPs, get your money back, and enjoy your goal. And final important time is when you think that structurally I should be more placed towards some other cap. For example, right now you are doing SIP and small cap, but you feel that small caps have given superb return in past, but now they are overvalued. Probably I am getting more value in mid cap or large cap space, or maybe my risk profile has changed. Earlier I was aggressive, now I am due to my conditions or my situation, and now I am a moderate or a defensive investor, and I need to change the aggressiveness of my portfolio, maybe because of my risk profile change, or maybe because of market scenario change. Then is the best time to change your funds. These are probably the three best situations to change your SIPs, pause your SIPs, or stop your SIPs.
Okay, so that's very clear. You need immediate liquidity, and remember that is what you have your SIPs going on for. If there is a crisis, definitely do use it. If you have achieved your goal. Now, the last one is a little tricky. Kshitiz, let me come to you on this. Achieving your goal. What if you've achieved your goal at a time when you feel that your investments will only grow higher?
Hi, Tamanna. Hi, Anant. Pleasure to be with both of you on this show. And I think, Tamanna, point is that whenever you plan your investment without any goal, then that will not last for long. It's like, you are just going for a drive and coming back. Whenever there's a destination which you achieve as a goal, you will end up continuing your investment for long. So I think it's very important every time, first of all, we are talking about when to stop SIP, or when you start a SIP, you should align that SIP with a goal. And then let's say you have a goal of buying a home and your target money is 1 CR, and let's say the markets have been really good, and that's what happened last 15 years. Getting 15% in the morning is what we have seen in many of the funds has come, and you are able to achieve rule of 15, which is 15,000 SIP, 15,000 SIP with 15% and 15 years, and you have got 1 CR. And the value of house which you want to buy is around 1 CR. You can take that money and you can stop that SIP, which is aligned to your that 15 years goal. That's the time when you stop the SIP, and then you move on for the next goal, whatever you want to do, and allocate that fund depending on what type of goal you have. Now, why we ask someone to stop the SIP, or let's say someone should stop the SIP, is because you don't know what type of goal you're targeting after this goal. Because if there's a goal which is less than 5 years, then you should look at somewhere a balanced advantage fund around 5 year large capish fund between 5 to 7 years. Look at large and mid cap and flexi and focus and multi cap fund. More than 7 years and 10 years, you look at mid cap and large and mid cap. 10 year plus small cap. So depending on next goal, you should align your next step in that fund so that it should not create one lesser returns for you if you have a long term goal. Two, you'll be not in a position to achieve your goal because you have taken an aggressive call in small and mid cap fund, but your goal is 3 years, 4 years. So this is something which is a very important task when you stop your SIP and start something new.
Okay. So, let me come to one of those portions. If your SIPs are, or if your fund is underperforming for 6 to 7 months, and this is a question I ask often, Kshitiz, I'll come to you for a follow-up. Just yesterday on the show, I asked someone, how long should you give a fund? And the answer was, say, at least about 3 years. You're saying 6 to 7 quarters, so say a year and a half, nearly 2 years. When do you decide that your money can be spent or utilized in a better way, and what should be the parameter just beyond the time frame that we're talking about?
Say if you have, as I said, 6 to 7 quarters is an underperformance in the fund, and if you see in the same category, let's say there's a category which is the same category, let's say we are talking about multi-cap funds or a flexi-cap fund. In the same category, the difference is huge now. So it can be a possibility that, let's say, one fund manager style is value, the other one is growth, and growth is working out. Then obviously you know that value will underperform if growth is doing very well. But if in a growth strategy only and in the same category only, if the underperformance is more than 6, 7 quarters, then is the time to actually see that whether you want to continue with that fund or, because once there's an underperformance which is for a couple of years, then covering that underperformance without taking some tricky calls, or I say some aggressive calls, it's not possible. We have seen that with many of the fund houses, unless and until you are a value strategy fund like HDFC. When Prashant was there, they used to have all value, more towards PSU side, and many of the years those funds have not done well. But when PSU started running, it started doing well. But that's a difference of approach between growth and value. Here I'm saying you are in a growth fund, you are in a, let's say, flexi cap fund, and there is underperformance for last 7 to 8 quarters, and that is something is playing out against you. That was, this is the time for us to think whether you want to continue with this fund or you want to move on with other fund.
Okay, Anant, what is your take on this underperformance as a factor to stop your SIPs? And if you are doing that, then should you look at reallocating?
Firstly, I feel that you should look at the category and then decide the time horizon of underperformance at which you are looking at. For example, if the large cap fund, which is underperforming for probably 1.5 to 2 years, it's time to switch and probably move out to a more stable fund or index fund. If there is a mid cap fund which is underperforming for around 4 years, then it is probably a time to switch. Because if you are investing in a mid cap fund, you at least need to give 3 to 4 years to your fund manager. If you're looking at small cap fund, because alpha generation in small cap is huge, you at least need to give average SIP days of 1800 days to your fund manager and then decide on to moving the fund, especially if the fund manager and his philosophy is stable. Now, if you talk about styles of investing growth, I feel as perfectly mentioned by Kshitiz, 3 to 4 years is good enough time. Even 2 to 3 years is good enough time. But if you are going with value theme, you know by default that in past, if you look at 10 years data, probably in 3 to 4 years, value is outperforming and balance year, they are underperforming. So you need to give at least 4 to 5 years if you're going with a value style, because that is how cycle works. In value style, we have always seen underperformance of 3-4 years and then significant outperformance in the coming few years. So if you will be moving out from a value strategy post investing for 3 years, you will probably be moving out at the most perfect time.
Okay, so value strategy is what you should look at. We'll take some queries as well from our viewers to, get real life examples of what you should do with your SIPs and when you should move out of your SIPs. Kshitiz, what about a sort of a tactical play as well? I mean, for investors that are a little more savvy, who are keen to look at sectoral themes, because that is one place where you need to be a little more aware, isn't it? Is it time to, for example, if I were to ask you if you have SIPs in infra funds haven't been doing that well, or PSU funds have not been doing that well, Is it time to move out? Should you have factors like that in mind as well?
I do not, Tamanna, tadka in dal is good, but right now it's only tadka. You see only sectoral and thematic funds paying out. I'm a little worried and scared.
Yeah.
And your show has been seen by many people. My message to everyone there is that, as you said, that tactical play should be 10%, 12% in the portfolio, not the entire portfolio, because you are seeing defense funds giving 80, 100% return, or manufacturing, or let's say PSU funds giving very good return, and you're parking your funds there. I think a diversified portfolio is a must, but yes, I agree with you. Somebody with a little better allocation, a little better risk profile in terms of taking risk, they can go up to 15% allocation towards your sectoral or thematic bet. But there are many sectors which can be really good for clients at this level also. But yes, tactical allocation should be there, and at the same time, you should be aligning your short-term goals on the tactical allocation side, because cycle will play out, and then it's time for you to move on and add to a diversified portfolio.
Okay, let's start taking some of your queries. Remember, if you want to write in to us, the numbers are on your screen. Our first query is from Rohit, aged 33, says, I'm ready to invest 1 crore rupees with a 25-year time horizon. Should I do a short-term SIP, that's 10 lakh rupees per month, or a lump sum in the current market? What could be the right mix of fund categories to invest in? I don't need this money for rainy day funds. Fantastic. Congratulations to you, Rohit, at 33. You have a 1 crore corpus to invest with a 25-year time horizon. Kshitiz, let me come to you first. First part of the question, should he do a SIP, a short-term SIP with 10 lakhs per month, or should he do a lump sum?
My sense is, Tamanna, he should look at doing 15 to 16 weeks STP, because the problem with us is if he would have been doing this SIP, continuing this SIP for long, I would have suggested that. As he has a long tenor on his side, which is 25 years, I think 15 to 16 weeks, which is in excess of 3.5 month STP, weekly STP make much more sense. And he can maybe do a 5-6 lakh weekly STP. That's what he can target at. And maybe stretch this STP a little bit. And then make a portfolio of diversified 4-5 good mutual funds, and continue with his wealth creation goal. So let's take, for example, if he do a good combination of index fund or smart beta index fund and multi-cap and small cap and mid cap fund, either of one, then if the portfolio can grow at 14%, he can easily make around 25-26 crore. And let's say if the portfolio will grow at around 15%, then he can make 33 crore. But let's say if the portfolio grow at 12% also, which is the nominal GDP growth, what we are expecting in next 8-10 years, still he can get 17 crore. And I think that's a fairly decent amount of money which he will have. But he has to take into account inflation, Tamanna. The thumb rule for inflation or formula for inflation is also same. It's 72 by R. And you can take inflation at 8%. I always take food inflation into account, and your value of money is becoming half every 9 years. So I'm good that, as you said, you have 1 CR at the age of 33, but at the same time, please do SIP also on a monthly basis on whatever cash flows you can spare, which should be 15-20% of your earnings, and allow your money to grow multi-fold. Because whatever amount you think that it's very good, 17, 18, or let's say 30 crore also, by the time 25 years will go by, and you'll see that amount as per inflation is not the right amount. So, you have to create a social net for yourself and keep saving.
Okay. What are the kind of funds? Anant, let me come to you with that question, and you start with the second part. What are the kind of funds you should put money in if you're starting afresh, say 10 lakh rupees a month, or even a 1 crore corpus?
See, if we look at present market valuation, and since the investor is having money to invest in lump sum, or maybe as Kshitiz also suggested, in 17 to 18 weeks, or maybe 10 lakh SIP, presently I would go for comparatively defensive large cap, flexi cap, maybe index funds, and multi-cap fund category to start off. I know small cap is a brilliant category. It has given over 30% CAGR in last few years, but I would use that as a tactical strategy. For example, if I see any dip in the market, for example, if I'm seeing a dip of 10% in large cap and around 15 to 20% in small cap, mid cap, probably that will be the time when I would be shifting my money from large cap to small cap. Presently, looking at present valuations and present scenarios, last year also there is a very interesting data that in small cap as a category, we only saw 89 negative days when a small cap index was negative. This is by far the lowest number of negative days we have seen in small cap index. And whenever there are low number of negative days in a particular year, probably in next few years, market is comparatively more jittery or comparatively more volatile. So looking at complete scenario, complete madness, and complete valuation, I feel we have to look at small cap category as a fund because we have 25-year of time horizon. But I'll use that as a tactical strategy whenever I see some significant amount of opportunity in the market. And presently, I'll go with comparatively defensive funds.
And what about the kind of structure to deploy the money, Anant? Lump sum, or you would say SIP?
I feel SIP of 20 months can be useful with the mindset that whenever the investor is getting 10% dip, he should put in around 10% of his corpus as a lump sum immediately. Very simple rule. 10% dip, additional 10% you will put at a corpus. For example, 2 months later, we see a 10% dip. He'll immediately pump in 10 lakh extra for that month. Or as Kshitiz rightly mentioned, he can go for 18 to 19 weeks of STP. That also works fine.
Okay, so a lot of options there for you. All right, next query coming in from Sonia, aged 52, says, I want to invest a lump sum amount of 25 to 30,000 per year for the next 5 years. Suggest some good funds I can invest in. So not too much detail there coming in from Sonia on what is the purpose of the funds or the time horizon, but let's work with what we have. For a 25 to 30,000 rupee amount, Anant, I'll start with you. A lump sum makes sense?
I think 2,500 rupees SIP might be a better option. But even if we want to do lump sum, we can probably decide a particular month, particular day, and follow it throughout the next few years. If time horizon is also 5 years, I feel large cap or index fund as a category might make more sense. Maybe at max flexi cap category we can look at.
Okay, and of course there's a 5-year horizon. Kshitiz, do you want to come in on Sonia's query?
I think I'm totally in sync with what Anant has said. Too short as a time. So 5 years is too short as a time, and moreover, at the peak of the market, I think it's good to go defensive. Maybe some momentum play on the index side. That's what smart beta funds they can look at, and totally flexi cap fund is what I will suggest because our age is also 52.
Age is also 52. That's correct. Let's take a look at a few more queries. Dipanshu has written in, age 30, says, I want to invest 2 lakh rupees in mutual funds and ETFs with a time duration of 3 years. Please suggest some options. Now, this is an interesting query because it also gives us an opportunity to talk about which one is a better option for Dipanshu. And Kshitiz, let me start with you first. 2 lakhs in mutual funds and ETFs, he says, but if it was an or question, MFs or ETFs, what would you go with?
My sense is that we should, or he should, look at balanced advantage fund category. That's a better play for 3 years' time if he has only 3 years on his side, because it's too short as a time for a pure equity fund. And he should allow fund manager to do his job. Maybe right now we are at a cusp of almost peak of interest rate cycle, and once you have US rate cut coming, India will follow the same. He can put some money right now in a gilt fund, long-dated gilt fund, maybe 50%, and once the interest cycle will play out, he can move out, and then he can put, if some correction is there, in balanced advantage or balanced equity hybrid funds. That's what I suggest. 3 years is too less for any direct equity investment, whether it's ETF or whether it's mutual fund.
Okay. What about you, Anant? What would be your advice to Dipanshu who wants to invest 2 lakh rupees in mutual funds and ETFs with a time duration of 3 years? What are the options you could suggest for him?
Completely in line with Kshitiz, maybe balanced advantage fund or asset allocator fund, which even has some allocation in gold as a asset class. Probably these two categories are the categories that he should look at. Also, if that goal is very critical, because he has specifically mentioned 3-year time horizon, probably he can even place his money in debt, because if that goal is critical and we see some jerks in market for any reason for that sake, then even balanced advantage and asset allocator as a category might take a hit. So he should look at the seriousness of his goal. If his goal is of top priority, which he cannot miss, probably keeping it in debt is also an option. Otherwise, asset allocator or balance advantage fund as a category makes sense here.
Just a follow up from there, Anant. He's 30 and has 3 years. One would expect you would maybe advise someone like this to be a little more aggressive in terms of equity, but your advice is a bit cautious. Is it because you feel that investors need to brace for the fact that they might not see the kind of returns they've seen in the last 3 years in equity mutual funds?
See, kind of, yes. More than that, I feel time horizon we have is 3 years. Probably we should never compare risk profile with the age. Probably he might have some liability or some important goal which is there, which might be very serious and of top priority for him. So I don't know the complete view and complete mindset of Dipanshu. That is why I couldn't ask him a follow-up question. Otherwise, I would have asked why only 3 years. Probably he can give us 5 years or 7 years. Then we might have given him a better aggressive option for that sake. And yes, presently market is valued. Putting lump sum here with a 3-year time horizon, journey won't be that easy, is what I feel.
No, so okay, I get that point. We don't know why he's given a 3-year horizon, and is there some kind of a necessity, which is why you want to protect the capital as well, and it's a shorter time horizon. But Kshitiz, if I were to ask you that, and that really is the query right now for investors who have seen a great run up in their equity mutual fund returns, do you think that there is need of a bit of a reality check about whether it will continue in that way? If you stretch the time horizon more in the past and look at 10-year returns, they definitely don't look as exciting as 3-year returns.
So I'm sure what you and Anant are gauging with regard to that, he might have some short-term goal. But I've been meeting a lot of youngsters of late, and they're talking about next 3 years. With regard to that, they can double the money the way they have doubled in last 3 years. So this is something which need to be measured on, and very rightly presented by Anant on this aspect. I think what we have to look at is, and this is for everyone who's watching us, if your nominal GDP is 12%, any company who runs with a big infrastructure, lot of employees, is generating 17-18% earning growth with expanding profitability margin, how we can expect returns from that company or underlying stock to give 25, 30, 40% every year? So this is something taken into account, that the right expectation from any mutual fund portfolios should be around 13-14% in the morning. And believe me, at 7-8% food inflation, handsomely you are beating inflation and creating a wealth for yourself. At 13-14% also, it's going to be a very good run-up for you if you focus on the time. And Tamanna, I keep on telling on most of the shows that future value, if you actually see how it gets calculated, is equal to present value bracket 1 plus R closed raised to power T. So we keep on focusing on return. One should focus on the time part. If you have time on your side, then you see how this compounding actually works. Then it doesn't matter you are at 13%, 14%. You are sorted. You have that wealth creation element on your side. You have that wealth for you, which you can enjoy through SWP. So I think what has happened in the past, and I'm glad many people in the country, they have made money. But at the same time, one need to expect and realistic expectation from markets from here onward should be 13-14% in the morning. Anything which you are getting as a plus should be a bonus for you.
Okay. All right. Hitesh joins in, and Hitesh's next query is coming in. He's age 37. He asks, what will be the perfect mix between large mid and small cap if I want to invest 40,000 rupees every month for the next 10 years? I'm looking for a 15% annual return. Should it seems reasonable for the next 10 years, a 15% annual return? Or is Hitesh being a little optimistic? What should be the mix if he wants to achieve this goal with a corpus of 40,000 rupees every month?
He's young. I think 50-30-20 is one should look at. So my Tamanna problem is that when I say 50-30-20, it should be not the fund side that you have 20% small cap, 30% mid cap, and 50% large cap. There are many softwares where you can actually calculate in a large cap also, or on the overall portfolio level also, how much is large cap, how much is mid cap, and how much is small cap. Whenever we say 50-30-20, it's on the portfolio level, at the portfolio level, and you can do that. Like large and mid cap, come what my 35% has to be small, mid and large. In multi cap, compound by 25% has to be in 3 categories. So you have to calculate on the entire portfolio level that this allocation, and this is very much possible. Having said that, it's always good that whenever he has his increase in salary or increase in business income coming his way, he should keep on stepping up. So don't constrain yourself that 40,000 is something which I want to do for next 10 years. Whenever you have some money on sideline which you can as a step up on your SIP side, just do that, because that will actually create a lot of delta on overall return which you are actually looking at right now.
Okay. Thank you so much, Kshitiz and Anant, for joining in today and for answering all our questions. Quite an interesting show. We talked about when to stop your SIPs and, of course, how you should look at your investments going forward. We've answered a lot of your queries as well. And if you want your queries answered, please write in to us. The number is on your screen. But that's all the time we have today on the Mutual Fund Show. Stay tuned. A lot more coming up on the other side on NDTV Profit.